my name is Renee Collins, and I am certified as a public accountant, and I am also certified as a financial planner. And I'm going live today because I want to talk about my favorite retirement planning tool. And I want to talk a little bit about retirement planning, because retirement planning used to be pretty straightforward. It used to be really simplistic. The idea was that you would work for an employer for 20, 30 years, and then you'd get your shiny watch and you'd get a pension and or Social Security. Well, that's changed. So retirement planning is not that simplistic anymore. This idea of retirement planning now is that people are really concerned about whether or not they're going to run out of money. That did not used to be the case. You get your Social Security, you got your pension, and you were set for life. Things have changed. In the 1970s, employers, they got a wind of that 401k plan. And so they started thinking, well, you know what? We don't have to shoulder the burden of retirement ourselves. We don't have to put contributions for retirement into these pension plans. We can actually shift this burden to the employees. And that's exactly what they did. Now, unfortunately, what they did not do is provide employees with financial education and financial literacy so that they would feel confident in making financial decisions about the next chapter of their lives. So today, more and more people are putting monies away into their 401k plans. And that's great, because that's what we want you to do, but we also want to make sure that you're educated around retirement planning in general, because retirement is not just based on your 401k plan. That's a great start. And there are other retirement planning vehicles that you can also consider for retirement. And that's what I'm going to be talking about today. Now, what I want to talk about is, we know about the 401k plans, but what about IRAs? How familiar are you with individual retirement arrangements? That's what I'm going to talk about. Now, there are a lot of varieties of IRAs out there, because you have the simple, you have the SEP, but those are for businesses. What I'm going to talk about today is I want to talk about the Roth IRA. Now, that is my favorite tool for saving for your retirement, is the Roth IRA. So what exactly is the Roth IRA? So what I'm going to do is talk about the contrast between the traditional IRA and the Roth IRA. So with the traditional IRA, typically if you put a contribution into the traditional IRA, you're going to get a deduction for it today. Your earnings, they're going to grow tax deferred. And then when you take a distribution from that account, a portion of it is going to be taxable. Now, the Roth, on the other hand, doesn't quite work that way. So with the Roth, you're going to make contributions into the Roth account, but it's going to be with after-tax dollars. So these are monies that you've already been taxed on. It may be sitting in your checking account, maybe it's sitting in your savings account someplace. So you're going to make a contribution into this Roth with these after-tax dollars. The earnings are going to grow tax-free. And when you take a distribution from that Roth account, that is going to be tax-free as well, as long as it is what's considered to be a qualified distribution. So that's really important to note. Now, the other thing that I want to talk about is who can make a contribution into this Roth IRA. With a traditional IRA, anybody can make a contribution as long as you have earnings at least up to the amount that you contribute into that traditional IRA. You can make a contribution into it. That's not necessarily the case with a Roth. So with a Roth IRA, if you want to make a direct contribution into the Roth, then you're going to bump up against some limits. If your income, your modified adjusted gross income, is under $141,000, if you're single, then you can make a contribution directly into the Roth. And if you're married, your modified adjusted gross income has to be under $230,000. So if you find that you're kind of bumping up against these limits, then you may have to consider a backdoor Roth IRA. And that is actually a video for another day. But it's important to note that everybody cannot necessarily make a contribution directly into the Roth IRA. Okay? Now, the next thing that I want to talk about is how much can you put into this account? So the limits for a Roth IRA are $7,000 if you are under the age of 50. And if you're over 50, then you get to put in an extra $1,000. So potentially $8,000 per year. Now, what's nice is that this is indexed for inflation. So as long as inflation continues to increase the way it is, then these numbers or these limits are going to go up every year. So right now it's $7,000 per year if you are under 50, and then it's $1,000 additional if you're over 50, so you can put in $8,000. Now, it may not seem like a lot, and granted, it's not the $23,000 per year that you can put into, say, a 401k, or $30,000 if you're over 50 and you're trying to put money into your 401k. So it's not those limits, but it's about $580 some a month. And if we were to figure you're investing $583 a month, and let's assume interest rate of about 8% on average per year, and you invest that for about 20 years. Well, at the end of that 20 years, you could have potentially about $300,000, so over $300,000. That is a nice pot of tax-free money. So nothing to sneeze at. It may not seem like a lot, but it can add up over time. So now we know how much we can put into these accounts. Now, the next thing I want to talk about, what are some of the benefits of the Roth IRA? So one of the benefits that I want to talk about is required minimum distributions. If you're not familiar with requirement minimum distributions, basically the way this works is that if you have a retirement plan with your employer, say you have a 401k plan, maybe you have a 457B, or maybe you have a 403B plan or something if you're working for a not-for-profit organization. Well, at some point in time, you're going to be forced to take a distribution from those accounts. Because remember, the monies that you're putting into these accounts, you're getting a deduction for it. It's growing on a tax-deferred basis, not tax-free. So that means that when you take that money out of that account, the IRS is going to be sitting there waiting with their hands out saying, you owe us a portion of that money. They're not going to allow you to grow that money in that account forever. So they're going to require that you take a distribution once you turn 73. Whether you need the money or not, you have to take it out. That's not the case with a Roth IRA. You're not forced to take your monies out until you want to take them out, until you are ready to use them. So there's no required minimum distributions with a Roth IRA. That's a great benefit, okay? Another great benefit to the Roth, and I already talked about that, is that distributions, as long as they're qualified, they're going to be tax-free. Now, one of the things that I really like about the Roth IRA is the flexibility. So your contributions that you put into that Roth, you can take that out and not have to pay any taxes on it at all. So I love that. Let's just assume that maybe you have a Roth IRA and you've contributed $10,000 into that Roth. And over the years, it's grown to about $5,000. I mean, not $5,000 to $15,000. So you have $5,000 in earnings. And if you need to take some money out for any reason, let's say you need to take out maybe $6,000 so that you can put down on a home, or maybe you want to assist your children with college or something, that $6,000 comes out tax free. You don't have to pay any taxes on that $6,000 because it is a part of that $10,000 contribution that you put into your Roth. I love that. So again, very flexible tool that you can utilize to save for your retirement, to provide you with a nice pot of money in your retirement as well. So here's some things that you might be thinking about. Okay, all of that sounds great, Renee, but how does that apply to my situation, right? So when we're talking about personal finance, it's just that. It is personal. So when clients come to me and they say, well, should I make a contribution into my Roth IRA? Well, the answer is going to be, it depends. It depends on your unique financial situation. But what I can provide you with is some guidelines, some things to kind of think about if this is something that you've been kind of mulling over for some time. All right, so here are 4 things to think about. 1, do you have a 401k match with your company? So if your company provides you with a match in your retirement plan, then you want to make sure that you are taking advantage of that match before you invest into any type of IRA account, because we are not in the business of leaving money on the table. So make sure you take advantage of your company match. And then if you want to put money into a Roth IRA after you have taken advantage of the company match, then feel free to go for it, because now you would have a pot of tax-free money that you can pull from in retirement as well. The other thing is to think about taxes. What tax bracket are you in today? You want to take a look at that as well. And then what is your general feel about taxes in the future? Because the reality is nobody really knows what taxes are going to be in the future. If you ask a financial expert, they're definitely going to say, I shouldn't say definitely, but a lot of them are going to say, oh, no, taxes are going to be much higher in the future than they are today because of the way the government is spending their money and because of the debt that the government holds today. But the reality is nobody is a soothsayer. They don't know. All we can do is to speculate. But I will say this, if you are in a high tax bracket, if you're in the 30%, 37% tax bracket today, it may make sense for you to invest in your 401k because you can get a tax deduction today. Unless you feel like, oh, I'm going to be in this same tax bracket when I retire, then it really doesn't matter. But if you are in, say, a lower tax bracket today, and you think that the taxes are going to be much higher in the future, then it would probably make sense for you to go ahead and invest or contribute into a Roth IRA today so that money can grow tax-free. And then in the future, as tax rates go up, if that's what you believe, then you can take that money out on a tax-free basis. So think about the taxes and what you feel the taxes are going to be in the future. So that's important. And the other thing I would say is, and I don't think a lot of people think about this, and that's tax diversification. You want to have some tax diversification into retirement because now you can control your tax rates a little bit in retirement. Most people are investing in their 401k, but they're not contributing money in any other tax account or retirement account, such as a brokerage account, which has favorable tax treatment as well, nor are they putting any monies into their Roth IRA. So if you want to have some control over your tax rates in retirement, then I definitely recommend that you think about putting some monies into that Roth IRA. And then the last thing to think about is legacy building. A Roth IRA is a great tool for building a legacy because remember, your contributions are going to grow tax-free. Distributions are going to be tax-free as well. And not just to you, but also to your beneficiaries. So if you want to leave some money to the next generation, a Roth IRA is a great tool to do that because you can leave that Roth IRA to a child, a grandchild, and then they can take monies out of that account on a tax-free basis as well. Now, they can't leave it in there forever, but that money can grow tax-free for quite an extended period of time. So that's my take on the Roth IRA. If it's something you're thinking about, again, let me just rehash. If you have a 401k with your company, make sure that you're taking advantage of that company match before you invest in a Roth IRA. You're not leaving money on the table. Take a look at your taxes. Where are you today? Are you in a high tax bracket today? And do you think you're going to be in a high tax bracket in the future? And if that's the case, it may not matter whether or not you invest in a Roth IRA unless you just want to have that tax diversification into retirement so you can control that tax rate. But if you're in a low tax bracket today and you think you're going to be in a higher tax bracket in retirement, then a Roth IRA is a great tool to help you, again, grow your earnings on a tax-free basis and have control over that tax rate. And then if you want to leave a legacy, a Roth IRA is a great tool to do that. It has a lot of flexibility. So last thing I'm going to say is this, is that planning for retirement has gotten a lot more complex than it was when my parents basically graduated from high school and they were able to get a job working for an employer who provided them with a pension. It's not like that today. Today, we have to be proactive and we have to be intentional with the way that we plan for our future because you don't want to give all of your money from your 401k to the government. You want to have something that's set aside so that you can better be more proactive in planning for your retirement. And this is not something that you have to go at it alone because, again, it can get complicated. So if you have any questions about planning for your future, about investing, whether it's in a Roth account or even in your own company's 401k account, feel free to reach out to us. I will make sure that I put my contact information in the description, and you can contact me for a free 30-minute consultation to help you start gaining some clarity around your financial planning. Well, that's all that I have for you guys today. I hope that you are, wherever you're watching from, that you are enjoying your day and you go be great until next time. Take care.